So let's start with our introduction to the Forensic Alpha Model, FAM, and in particular, we'll focus on North America. Take a look at our agenda. We'll look at the history of forensic fraud detection by GMI and the first model we've ever created called AGR. We'll talk about stock returns and fraud detection. Then we'll talk about the shortcomings of AGR and of using SEC actions with respect to equity returns. We'll talk about the New World, FAM. Then we'll focus on FAM in North America. And finally, I'll save the best for last, and probably the most interesting part, a sectoral neutral optimization using FAM in North America and how you can outperform the benchmark by 300% and reduce your risk by nearly 50%. It's important to understand sort of the beginnings of this company, and that was back in 2002 with the fraud epidemic apocalypse. There was a true fraud epidemic that hit the US markets. NASDAQ went from 5,200 down to 1,500. And even more impressive, the big five accounting firms turned into the big four when the largest auditor in the United States, Arthur Andersen, was shut down by the Securities and Exchange Commission because of their involvement in not just the Enron fraud, but some of the other big-name frauds. It was that fraud apocalypse, that epidemic, that was the motivation or incentive for the creation of the firm. And the first model we set out to create, the AGR, Accounting and Governance Risk Model, took a look at the world from a forensic point of view rather than a fundamental point of view. We got a whole bunch of smart people in a room, and they educated us on the difference between forensic analysis and fundamental analysis and how auditors look at the world. Our singular goal was to create a model designed to identify the fingerprint of fraud. And by fraud, we mean specifically a model trained on SEC enforcement actions of accounting fraud. And lucky for us, AGR was good what it set out to do. In fact, if you look down at this image, if you think about the best rated companies as being very transparent, and the worst rated companies as being very opaque, to the extremes being fraudulent, so we have this continuum, the worst rated companies by AGR are 13 times more likely to face an SEC action of accounting fraud than the best rated companies. So lucky for us, we had a good model. It turns out that when you have a model that can predict fraud, you also have a model which can predict class action litigation, can also predict financial restatements, can also predict financial distress and bankruptcy. Turns out the worst rated companies are 500 times more likely to face bankruptcy than the best rated companies. So lucky for us, we had a fraud model. Before we move any further, let's talk about what AGR is built on. What are the guts of AGR? And how do you identify the fingerprint of fraud? And it's all based on metric operations. We break the world into governance and forensic accounting. That's our taxonomy, where peering is the key. We have a proprietary peering system where we go by hand and put each company in their appropriate industry, and then we bifurcate those industry by size using either operating revenue for industrials or total assets for financials. And here are some of the things we look at. Also, I'll show some more examples in FAM, but just for a broad look, on the governance side, some examples are executive insider stock sales divided by the total equity of the firm. We'll look at the trailing 12 months of this metric and then compare that to the peers. Again, peering is the key. We'll look at things like the CEO and CFO incentive pay divided by their annual compensation and look at the number of interquartile ranges, that is from the industry median. Again, industry median requires a peering. On the forensic accounting side, we'll look at something like accounts receivable over sales, and then we'll take an operation on that, like the 2-year volatility, which would be the error term from a univariate regression, again, relative to peers. It turns out that for these forensic accounting metrics, if the volatility is unusual relative to peers, that is, it is large relative to peers, that in fact does fit the fingerprint of fraud and also has information relative to stock returns. The important thing to note here is twofold. First of all, just taking ratios does nothing. The public market, the equity market, has consumed ratios. All that information has been gleaned. What you have to do is take a learning algorithm on top of these metrics in order to get information. And so the guts of our model are what we call metric operations. And there's a 2-year volatility operation, there's a 1-year change relative to peers operation, and then the current period industry comparison, where we look at the number of interquartile ranges from the median. The second thing to remember, again, peering is the key. Without a proper peering system, you cannot compute metric operations that are meaningful. Now, there is a secret as to why SEC actions fail to capture the full picture with respect to equity returns. So it makes sense that having a model that can predict fraud well would in fact predict, at least on the downside, stock returns. And it does, to a small degree. And we do have investment managers who continue to use AGR as a part of their risk factors. But the newest academic research and private research tells us that the SEC only catches about 1 out of every 7 frauds. Or said differently, the SEC misses 85% of the frauds. And that's not to cast aspersions. The SEC is there to act as a deterrent, not a catch-all. It's absolutely impossible for the SEC to catch every fraud. So what they'll do is they'll enforce an accounting action on a $1 million market cap company, and then they'll enforce an action on Apple, the largest company in the world, just to say, hey, the SEC is watching everyone, but we're only catching a few. The fact that the SEC is missing about 85% of the frauds does have a direct impact on a model to predict equity returns, which specifically is the data set is incomplete. We're missing 85% of the data. But there's even more difficulty using a fraud model, AGR, in order to predict equity returns, and that is the implicit relationship. It makes perfect sense to us to think that if you can predict fraud, you could probably predict stock returns to some degree. But here's the secret about SEC enforcement actions. When the SEC accuses a company of being fraudulent, they don't just put an X by their name and say this company is fraudulent. They actually name the quarters that were included in the fraud period. And the average fraud period is about 10 quarters, so 2.5 years. So if we think about Enron, which is sort of the great example of a company that committed a fraud and went to zero, yes, certainly the 7th largest market cap in the United States, which today would be the equivalent of Microsoft, went bankrupt because of a fraud. But lest we forget that Enron became the 7th largest company in the country because of fraud. And so there is a timing issue with respect to identifying a company's fraudulent behavior and actually seeing an expected stock move. Another weakness in using an SEC model or a fraud model in order to predict stock returns is that the SEC only has purview over the United States, which means there is no regional distinction when we go to Western Europe, Asia Pacific, and Japan. We simply say that fraud in the United States looks just like fraud in these other regions, and that turns out only to be about 70% true. Finally, something we wanted to address in the AGR model is that our univariate measure that we use is the odds ratio in order to determine if a metric belongs in the model or not. So we have 360 forensic accounting and governance metrics, but certainly 360 don't make it into the model. For AGR, it's about 90. We used an odds ratio to determine if a metric made it into the model, and it turns out there is something better. So let's go to the new world, the forensic alpha model, a model which will address the issues of using SEC actions, or fraud, to predict stock returns, yet still using forensic accounting and governance. So the most important part of FAM is, in fact, that it's built on the same guts, the same repository of 360 forensic accounting and governance metrics that pinpoint the fingerprint of fraud. It's the identical repository, or the identical apple tree, that AGR has access to, that our bankruptcy model has access to, that our litigation model has access to. We are the forensic accounting and governance experts. We are not experts in fundamental analysis. So how did we build FAM? First, we used large stock moves rather than SEC actions as the training set. And what do I mean? For North America, we took the years 2002 to 2007. Then I took quarterly stock returns, and I only included companies which moved up or down 10%. Then I took those companies and ranked their stock returns from 1 to 200. The companies from 160 to 200, so the top 20%, were included in the training set. And the companies ranked from 1 to 40, the bottom 20%, were included in the data set. And I did this for every quarter. So now we explicitly are modeling stock returns on stock returns, namely the top 20% movers and the bottom 20% movers, while also making sure that the moves are not trivial, that is, they're greater than 10% in absolute value per quarter. That addressed issue number one. Addressing the issue with odds ratios was fairly simple. We moved to something called the Summers' D. Summers' D is a non-parametric statistic designed specifically for univariate analysis. It's actually an old statistic which only recently has been discovered to be so powerful. The newest academic research tells us that the confidence limits for Summers' D and their differences are actually more informative than the traditional practice of reporting only p-values. Or in English, Summers' D is a better univariate measure than odds ratios, correlations, or tetracorrelations. So using Summers' D, we went back to the apple tree of 360 forensic accounting and governance metrics and allowed this univariate measure to select which metric operations would make it into the model. Now that we're using stock returns, though, we no longer fall under the purview of the SEC. So I was able to do this process by region. And in fact, not only do you see different counts of metric operations by region, right here, there are actually different metric operations themselves in each region. There's about a 70% overlap, but there's some fascinating differences that pick up the idiosyncrasies of each region. And we're now allowed to do that. using stock returns. Let's get back to an example of actual metric operations that are in the forensic alpha model. I'll just focus on North America. We have both positive metric operations and negative metric operations. A positive metric operations means the larger the metric, the better it is for stock returns. Examples of those are, first, two forensic accounting metrics. If you take a firm's operating revenues, divide it by their operating expenses, then take the number of interquartile ranges, that is, from a very specific peer group bifurcated by size. The larger this number is, the better it is for stock returns. Not a huge surprise. Another example is long-term investments over total assets. If the 1 year change relative to a peer group and then bifurcated by size, the better it is for stock returns. On the governance side, we have a Boolean or some Boolean metric operations. If there's a stock buyback, it turns out that silly little metric actually does have a little bit of information for stock returns, believe it or not. A slightly more involved governance metric would be the independent director's average tenure, the 1 year change relative to the peers. If that number is growing, if the 1 year change is large relative to peers, that actually benefits stock returns. Some examples of negative metrics, that is, metrics the larger they get, the worse it is for stock returns, are, on the accounting side, operating revenues over operating expenses, the same as the first one up here, but this time the 2 year volatility. Here we see that if the volatility in the operating revenues over operating expenses is very large, this is actually bad for stock returns. Note how we have two of the same metric, one positive for stock returns, one negative, but the metric operation is different. And that's why you can no longer just use ratios in a realistic and rigorous quantitative model using forensic accounting and governance. There simply is too much information that has to be taken beyond just the ratio. Another one is asset total turnover, the 2 year volatility. If there's a lot of volatility in asset turnover, that turns out to impact stock returns negatively. On the governance side, if the stock-based compensation over operating expenses grows a lot over the last year relative to peers, and again, that peer group is proprietary, and then it's bifurcated by either operating revenue or by total assets, turns out that that's bad for stock returns. On the Boolean side, if a company needs a financing, that turns out to be bad for stock returns. An example, I wanted to include one that was relatively obvious as well. The North American model is composed of 64 of these metric operations. This is an example of 8 of them. The final step we did in the forensic alpha model in order to improve it from the AGR model, or in other words, in order to improve it from a model which predicts fraud and then implicitly predicts stock returns, is to allow for interactions. And one simple example is probably good enough. Imagine that you got information that there's a stock buyback. It turns out in North America, as we saw in the prior slide, that if there's a stock buyback, that's actually positive for stock returns. But what if I then told you that the CEO is also selling shares at the same time? It turns out that when these two things happen together, it's actually bad for stock returns. And that's one example of a very simple interaction. So while we need metric operations in the guts of the model in order to compose it, we also need the interaction of those metric operations in order to really pick up a signal that is unique. It turns out that signal, that interaction, has to be nonlinear, and the nonlinear classifier I use is something called a neural network. Now, for those of you that are used to supervised learning algorithms or artificial intelligence, you're used to neural networks. They're actually pretty old. They had their time in the light back when the BBC did their television series, The Machine That Changed the World, with text recognition. We've now moved well past neural networks in this realm. But it turns out, just like the Summers' D, which is an old measure, the neural network, which is also an old nonlinear classifier, actually turned out to work best for purposes of predicting stock returns. For those of you who are not familiar with a neural network, I'll just give you a simple example. This is the actual neural network that works for FAM, and it's actually pretty simple. You take the accounting score, you take the governance score, you take a multiplicative interaction between the two, and then you have them interact with each other on 3 different nodes. You weight these nodes based on machine learning, and you get out a final score. And that's it. That's how the FAM was built. Some more details, some more rigor. Probably the most important part of the forensic alpha model is not the neural network or Summers' D, or even the metrics themselves, it's the sampling. The in-sample was 2002 to 2007, so 6 years. And in fact, I took companies that were between $200 million in market cap and $100 billion in market cap. Then I took those that moved plus or minus 10% in a quarter. And then further, I took only the top 20% of those. and the bottom 20% of those. If you do that math quickly in your head, what it means is that only 20% of the companies during this time period made it into the model. 80% in this time period are in fact out of sample. Then we have a true out of sample, 2008, 2009, 2010, 2011, 2012, and now 2013, which is 100% out of sample. If you combine these two, what you find is you have a model which is built on 8% in sample and 92% out of sample. Or said differently, there simply is no overfitting in the FAM model. In fact, if I were to give you these 6 samples and just number them 1, 2, 3, 4, 5, and give you the stocks, the names, and the returns in the FAM rankings, you wouldn't be able to tell me which one of these 5 was actually the in sample. Another great thing about these time periods is market cycles. 2002 was a bust. 2003 was a boom. 2004, 5, 6, and 7 were normal years. So we went through all 3 cycles in this time period. Similarly, in our out of sample, 2008 was a bust. 2009 was a boom. 2010, 11, and 12 were normal years, and 2013 was another boom. So in both of our time periods, we have boom, bust, and normal market activity, which means the model was trained and tested on the full market cycles. Another alleviating factor is the fact that we used percentiles of returns rather than returns themselves. And because I percentiled each quarter, it means that we've eliminated market cycles anyway. Relative to industry, it turns out that we use FactSet for our stock data. They have very good stock data, and they break the world up into 20 industries. In North America, the best rated 5% of companies relative to the worst rated 5% of companies, or the best rated 20% of companies relative to the worst rated 20% of companies, outperform in every single industry. That is to say, FAM in North America works for all 20 industries. In Western Europe, you'll see that for 19 out of 20 industries. The one industry that doesn't work is health services. And one thing that I didn't mention prior is that this in-sample does not include biotechs. And that's because biotechs move on products, they move on PDUFA dates, they move on FDA trials. These are things which we do not believe the transparency opacity continuum can predict, and therefore we exclude them from FAM. So said differently, FAM works in every industry it's supposed to. Let's look at some very generic output covering 2002 to 2013, so 12 years, in North America. We can see that if we take the whole sample, all 12 years, that the best rated FAM companies returned 14% a year on a compounded annual growth rate with a 16.2 standard deviation, while the worst FAM companies returned a negative 7% with a standard deviation of 28.7%. So the difference between the best and the worst was 21.1%, and you can see how that would change in a $1,000 wealth chart. But of course, the question is, well, how much of that result is just because of the in-sample data? Well, let's take a look. Let's look at the full out-of-sample and exclude the in-sample. So now we're only looking at years 2008 to 2013, so a 6-year period, which is 100% out-of-sample. The best-rated companies actually do better than in the all-sample, and the worst-rated companies do a little better as well. Ultimately, the difference between top and bottom is nearly identical. So the out-of-sample, as I said prior, works just as well as the all-sample. But let's dig even deeper. Maybe I'm just selecting the data in a way that looks favorable to FAM. I mean, 2008 was a bust, and we know FAM does its best in years where the market goes down hard. Let's look at the years 2010, 11, 12, and 13. Another 100% out of sample. And what do you know? The difference between the top and the bottom is actually better than the all sample or the 2008 to 2013 out of sample. In fact, these numbers are not statistically significant. So the conclusion, as I mentioned earlier, is actually pretty simple. There simply is no overfitting with FAM. It works across all periods, whether it's the all sample, the out of sample, or even just the most recent part of the out of sample. But the real question is, why is it happening? What's going on? And the answer to that cannot be it's a neural network, and the answer cannot be it's a sum versus D, and the answer cannot be it's an optimization, and the answer cannot be it's metric operations. The answer must be something that's qualitative. And in fact, there are two answers. There are two reasons. There are two phenomena which prevail in FAM. The black swan effect and the positive returns effect. I'll just use North America as our example, but these results are nearly identical across the globe. First, the black swan effect. From 2002 to 2013, a 12-year period, we took monthly returns. And it turns out the best ranked FAM companies versus the worst ranked companies showed stock returns, black swan returns, or a monthly return, down 30%, 7 times more often in the worst rated companies than in the best rated companies. You can see the incidence. For a black swan or a stock drop of 40% or more in 1 month, we can see they occur 9 times more often in the worst rated companies than the best rated companies. Similarly, for 50% and even 60% stock drops, you can see they occur 27 times more often in the worst rated companies than the best rated companies in FAM in North America. And if you're curious about statistical significance, which you should be, the statistical significance is greater than 99.9999 and 108 decimals out. In other words, it's absolutely certain that the best rated companies show far fewer black swans, large stock drops, than the worst ranked companies. So this is the first phenomenon that's driving FAM results, is that the worst rated companies black swan and the best rated companies don't. Effect number 2 I call the positive returns effect. This is on the opposite side. This is on the upside. If you take the best rated companies and compare them to the worst rated companies, whether it's the best 5% or worst 5%, or the best 10% or worst 10%, and this works for larger populations as well, for example, the best 20% versus the worst 20%. If you just look at the incidence of monthly returns that are greater than 0, literally greater than 0.0%, the best rated companies have a tendency simply to not go down, whereas the worst rated companies do. You can see that in both buckets. And again, if you're wondering about statistical significance, you're looking at 99.994% or greater statistical significance between these populations. Finally, let's take a brief moment to look at an optimization, the simplest sort of optimization possible. I simply want to take a look at how FAM works if we neutralize sector. We're looking at the same time period, 2002 to 2013, so 12 years. The benchmark during that period returned 8.1% compounded annual growth rate. Here's the standard deviation. The information ratio is quite low, 0.37. First, let's see if we just take a long-short portfolio of the best and worst FAM companies. You see that portfolio outperforms the benchmark by more than 100% with lower risk. We can see an information ratio expansion of 126%. But that's still unoptimized. That still may have a tilt toward industry. Let's see if we simply took out industry bias in a long-short portfolio. And what do you know? The compounded annual growth rate is even greater than FAM on itself. The standard deviation is significantly lower. We're now looking at an information ratio of 1.55, where the benchmark had 0.37, or an information ratio change of 317% simply by going long the best FAM companies and short the worst FAM companies, but remaining sector neutral. So FAM in North America works across time frames. As we saw, it works from 2002 to 2013, or from 2008 to 2013, or from 2010 to 2013. FAM works for short ideas. That's the black swan effect. FAM works for long ideas. That's the positive returns effect. Better returns, lower standard deviation of risk, information ratio expansion. FAM works for long-short portfolios, optimized for sector neutrality, and certainly they work even better if it's optimized for styles. But there's one other thing FAM does. It works for index enhancement. But that's another story for another time. Thank you for watching our presentation on the forensic alpha model, specifically in North America.